and welcome to Business Line. China's stock market crash has been largely overshadowed by the Greek crisis in Europe and in the headlines here. But it does not mean that it is less important. On the contrary, many say that this crash might have a greater impact on the world's economy than the crisis in Greece. We will not compare. Instead, we'll analyse what exactly has been happening in China, not only over the last months, but over the last few years. The stock market has been in meltdown mode since mid-June. All this time, the country's government has been doing its best to stop the financial bleeding. The question is whether the plunge is just an ordinary correction after a year of big gains, or if it's the first sign of deeper problems in the Chinese economy.
Shares in China continue to slide on Tuesday following Monday's huge sell-off. The main index, the Shanghai Composite, was down a further 1.7%, having fallen 8.5% the day before. The government has tried to calm the situation, saying it will put in place monetary measures to stabilise markets, but that hasn't stopped criticism from some investors. The market's dead. The government should have told the public they were planning to save the market. If they're in difficulties, they should tell the public. Don't give us slogans like "we have the ability," "we have confidence," "we have the right conditions." That's just cheating us common people. These slogans have to be followed by details. The market dropped so much yesterday, but I didn't see any official news on the media. It's a trick to cheat the people. Since the middle of June, the government has implemented measures to try to calm the markets, limiting short selling, cutting interest rates, cancelling public share offerings and even banning share sales by major stockholders.
I think they will sadly not tighten up on the margin lending. I think they will probably cut rates yet again. They will inject more money into the system, but they won't do what is needed to fight this market terrorism, which is to really contain the margin lending itself. And that's why they're going to be breeding the grounds for the next market rout.
The country's central bank said it would inject a further 50 billion yen, 7.2 billion euros, into the money markets, but it might not be enough to stop the slide.
The Chinese stock markets have experienced significant turmoil in recent weeks, with Shanghai Composite Index, the country's major reference, falling by more than 30% since the 12th of June. If you're still not impressed, well, listen to this. This 30% is $3 trillion wiped off the Chinese stock market, 10 times the entire GDP of Greece. But this fall was preceded by an equally sharp rise. Earlier this year, China's share market had been one of the best performing in Asia, if not in the world. Why is that? Well, unfortunately, not because of the broader economic gains. Rather, that was a result of more and more people investing in the stock market with borrowed funds. More than 40 million new stock accounts were opened between June 2014 and June 2015. 12 million were created in May alone. Who are these newcomers? Well, that's the most interesting question. That could be anyone, college student or cab driver. They pushed the stock market up by 150%. What did they do it with? Where does the money come from? Well, they have all been mainly using borrowed money to invest. The so-called margin trading used to be heavily restricted in China, but the authorities have gradually loosened the regulations since 2010. That's why today about 80% of investors are not finance professionals, but individuals who were spurred on by government's policies that encouraged investment in the markets. Many analysts say that what's been happening now is a correction and the shares have been overvalued for a long time. But more warn, if it turns out that Chinese investors have been putting their money into risky, poorly regulated investments, there could be a spillover effect, just as the US mortgage market collapse caused a major financial crisis in 2007 and 2008. One of the world's most famous business and economic newspapers is changing hands. The Financial Times was sold to the Asian media conglomerate Nikkei. British publisher Pearson had owned the FT for almost 60 years. Nikkei now promises not to change the FT's style and, what's more important to the readers, its editorial standards.
Under new ownership, but not afraid to take its new bosses, the Japanese media company Nikkei, to task. It was in 2014 the Financial Times was critical of its new owner's previews of Japanese corporate earnings, which it said were systematic apparent leaks from companies to the newspaper. Will there be editorial clashes in the future? Faced with reporters, the chairman of Nikkei admitted his English wasn't good enough to read the FT, but its editorial independence will remain. I won't try to change the FT's management or editorial styles. It will remain unchanged as the Financial Times. I've already said to the paper's chief executive, John Ridding, that the FT becoming stronger is beneficial to Nikkei. The company's €1.2 billion purchase of the 127-year-old FT stunned the media world. The Japanese paper dominates business coverage in Japan, but is a stranger overseas. What influence will it bring to bear on the FT?
I think you might begin to see a shift in some of its coverage. Also maybe in the tone as well. Certainly the FT has been the leader of the voice of the sort of pro-European element in British politics, and that may start to evolve slightly differently if you have a new owner.
There are no planned staff redundancies or mergers of the two papers' bureaus, according to Nikkei, but some expect changes.
Kind of happy, they kind of know things are going to change, but it's interesting, yeah.
It's very early stage, I can't really say, because I mean we don't really have enough information about our new owner.
It is information which has made the Financial Times a global authority, an undoubted attraction to its new owners, who have pledged investment to support the FT's future growth.
A few months ago, Microsoft announced the release of its last version of Windows. Afterwards, it became clear that the company rather meant the end for Windows the way we know it. But the initial statement was shocking. This time, Giacomo brings on all the other confusing statements and intriguing promises to tell you what exactly is all this about. This is it. This is IT.
And this is really it. This week marks the debut of Windows 10. But before the usual tsunami of excitement and criticism, it's important we set a few records straight. First, even though the launch date was this Wednesday, not everyone will be able to get their hands on it right away. Microsoft is releasing Windows 10 in waves, starting with 5 million insiders, people who tested early versions, and then moving through pre-orders gradually. The goal is to avoid overloading, since this will be the biggest update campaign in history. Which brings us to the second myth we need to debunk. Windows 10 is available as a free update, but only for owners of Windows 7 or 8. If you still use XP or Vista, you're gonna have to buy it. Oh, and forget the rumors about pirated versions upgrading for free. That's also untrue. Moving on, we can confirm that some manufacturers are offering new machines running Windows 10 starting from day one. On the other hand, if you want to keep your PC but don't have a fast connection, you'll have to wait for the availability of USB keys. In fact, Windows 10 marks another very important milestone. It's the first Windows to say goodbye to retail DVDs. That was it. That was IT.
That was it for now. Thank you for watching, and we'll see you next week.